Hey investors, Bradley here from Watson Estates, and you're listening to the largest and fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. Today we're going to talk about what the hell is going on in the 2022 real estate market. The saga continues. And what exactly happens in July when interest rates continue to go up? What does that mean? How is that going to affect your portfolio as an investor? And which real estate companies have taken the biggest blow in 2022? They're getting beat up by the current housing market. We're going to talk about all these things and more, get you guys caught up so you can get out there and succeed in the changing and volatile market we're in today. But before we get there, just to give you guys a bit of an update, some of you don't know this. I don't think mentioned this on our show, but I say it on an ongoing basis. So for those of you who see me frequently, just pass this story on because I think it's hilarious and I definitely think it's worth sharing before we dive into this. Obviously, you guys know we just had a baby. This is our third week now. Blake has entered the Watson household, but I was looking through and it's very fascinating to me when I look in my career in real estate. The 3 years that I've been able to overcome and really hit record numbers have been the years the kids were born. So 2017, my eldest Emily was born. 2020, Hannah was born. And now 2022, we got Blake. And so do children make me more productive? This is really, the good fortunes of having kids. And if I was a betting man, I'd say these kids are bringing me that good fortune. Some folks like fortune tellers who warn of danger. Some like to find fortune tellers who keep emotions out of the readings. And what do I want? Well, I prefer a happy medium. But I'm just kidding. All of this is a joke. The truth of the matter is, if you think about those years, 2017, 2020, and 2022, those were all years that the market crashed. So not only did my kids bring good luck to myself and my business, but they also managed to crash our housing market. So bad luck for you. Brad, no more kids, right? Anyways, if you guys could, if you're loving our show, please consider subscribing. You can DM me on IG. That's at Watson Estates, and our link tree is in the bio on our Instagram account. You can keep up to date with all the fun stuff we got going on over there. But today, we're going to get into what's going on in the housing market. I owe you guys an update, but haven't been on screen for a little while here. And so this is where we're going to start. What the hell is going on? So we're going to start with a Move Smartly article today, talk about sales, we're going to talk about houses and then condos, and we're going to work our way through to interest rates and what happens in the future. So sales, Toronto housing market has the lowest sales volume in 20 years for the month of May. 20 years aside from 2020. So 2020 is the only case in a May where we had less sales. So it's been in the name of sales, it's technically been bad in our market. House sales in May are down 40% over last year and down slightly when compared to last month, which is odd when you consider May is kind of the peak of spring. Why are we going backwards here? It just all paints that picture for you. Now, as for price, the average price for a house in May was 1.45-ish, down from 1.68-ish in February. And that's a 16% drop in 3 months. 3 months going into spring. And to put that into perspective for you, in the late 80s, back between March 1990 to April 1992, house prices dropped 28% in 6 years. 6 years, 30%, or 15% in 3 months. It just shows you the speed. And fun fact, it took 13 years to get back to that 1989 level, the houses. So yet, average home prices are still up 17% over last year. So what you're saying is we could drop just as bad as the early 90s and still be up year over year as a percentage. Yeah, weird, right? So I guess the question here that I'm still left uncertain about, and maybe you guys have a comment on this, are we looking like 2017, right? We see a bit of a correction, a psychological shift, mostly in the suburban markets. We'll get to that. Or are we looking more like the late 80s and early 90s? And even if we do, the heat that we've had in our market was so high leading up until this year that it doesn't even put us back. So is it more than that? There's a lot of unknowns, and the big factor of all of this is going to be the inflation battle in the way of interest rate hikes. And that's That's the X factor we're going to talk about. But new house listings going back into May were flat compared to last year, but well below previous years, while the number of houses available for sale at the end of the month or active listings at the end of May was up 23%. So we have this kind of growing number of active listings in the houses. Well, what about condos? Well, condo sales were down 35% in May over last year and still below pre-COVID sales volumes for the month. Well, the average price of a condo has gone to $795,000, down from $840,000. A bit of a beating there, but it's only dropped 13% relative to the 17% that we saw for houses. For new condo listings, we're up only 3% over last year and ahead of typical new listing volume for the month. The number of active listings for condos was up 21% over last year. So in both cases, we have a rising active listings number. The first half and the second half of May was definitely a shift. We won't get into week by week, but there was definitely a transition that happened. What we will talk about is what the current months of inventory is and what the kind of changes in the number of active listings is. We'll get that later in the show. But when we talk about who's been most impacted last month, the places that have been beat up the most are actually the GTA suburbs. We've covered this in the last couple episodes, but Toronto housing crash, this is an article from the Dales Report. The Toronto housing crash up to 36% in some GTA suburbs since February 2022. February is that token top number for every area. Well, we have seen extreme examples play out in the GTA of price declines. I'm going to give you a few. The big one, the ticket item here, is King, Ontario, which has dropped a whopping 36% on average. We have Scugog fell 26.4% in Oshawa, the token child pre-collapse of what it could look like to have an overly heated, unbelievably low months of inventory, massive sales and listing ratio. Well, today, here they are, dropping from February at 23%, over 20% drop in a few months out there in the East End. Paradoxically, some regions have actually experienced price gains. That's right. They're exclusively centered to the Toronto proper neighborhoods. Toronto Centre is up 6%. Toronto West is up 5.1%, where prices never seem to drop irrespective of deteriorating market conditions. What's fascinating to me as I've been talking to reporters and trying to walk through this, I'm trying to make sense of it in my mind, right? These are the numbers. We have the numbers, but I feel like this is the heart, and you got to chew on it. We're like a bunch of cows, real estate cows chewing the cud on what exactly is going on. And here's how I've kind of pieced it together in my mind a little bit. Not a perfect example, but the way I look at it is the difference between Toronto and the GTA suburbs. The suburbs experienced a massive overinflating during the COVID pandemic. Everyone was running collectively to the suburbs. Well, so now we have an interest rate adjustment taking place. The interest rate in the way of affordability should affect the entire country equally, right? So if you're assuming buying something you can afford, everyone is getting hit with those same changes in the mortgage rates and even the psychological impact of the interest rates. The big difference between the downtown proper and the GTA suburbs is potentially more psychological and kind of this overheating that was taking place. So even though it feels like, the sky is falling, maybe the sky that fell is really just pulling back on the massive increases that took place, because downtown Toronto didn't experience those growths. I know a lot of listeners were disappointed by that, but we kept encouraging you guys, don't worry, don't get caught up in the runaway, because eventually things will circle back. Well, that's what's happening, right? We didn't see the massive increase in the downtown core, but we saw the massive increase outside. Now those have pulled back in a very tremendous way. Meanwhile, we don't see the pullback happening in the city. But interest rates aren't done. There's still more coming. But for now, you could make an argument, at least to me, it makes sense, that maybe interest rates isn't alone the reason for the price adjustments. Maybe it is, in fact, a heat coming out of the market in these areas that have been overheated because of the pandemic and all of the supply side crisis impacts, sales and listing ratio, all the factors we were tracking are starting to come out of the market. BlogTO had an article. I'm just going to mention this. Home prices expected to plummet across Ontario is the name of the article. But Desjardins, in this article, they say we'll likely see the largest corrections within a couple hours drive of Toronto. So when they're projecting, what are we going to see as far as who gets hit the most? You kind of are talking at that suburbs. And so this is something we've seen so far, but more likely than not will continue to transpire. One part that's kind of playing into this is this over asking, right? This like how much did you sell over asking? I saw an article we're talking about out in Durham as the poster child in Oshawa, $400,000 over asking. I actually heard one of those somewhat recently, but at a macro perspective, when we look at the numbers, there's been a definite shift in what prices are selling for, the final sale price relative to the list price. There's been a big change. When we go back to January, I'm just going to do 416. The 905 is close. They're pretty similar. So let's just stick with the 416 for now. In the GTA, 112.7 over asking. 116 in February. That was the top, right? March, 112. So then March is where people were kind of playing and getting caught. There's a lot of opportunities in there for savvy investors. Then we saw April, 107. Now in May, we just saw 103. So we're almost selling at asking price as a whole. Right? Playing in there, you have these still hot markets, these high-end homes that are selling they're still getting multiple offers. But when you look at it from a big perspective, people are kind of getting what they're listing at, right? And so that's changing. The pricing strategy is playing out. It's a big drop, 116% over asking down to 103 in a matter of 3 months. When we look at the months of inventory, we see this kind of supply of home coming in. In the freehold segment, we're above 2% for the first time since June of 2020. That will continue to trend up in my mind. And the condo months of inventory above 3 months of inventory for the first time since December of 2020 also will continue to trend up. When it comes to months of inventory, I think the game here is if you get between 5 to 6%, it's considered a balanced market. The rapid transition that's happening here, I think, is already playing itself into a buyer's market in some segments, but you got to really dive into what's going on in your neighborhood. You guys should be consulting your realtor and keeping track of the stats in your area. But in general, we see months of inventory and continuing to rise. But the good news, if you want prices to stop dropping, is this. There might be a little bit of a leveling off that's happening when we look at the stats in the May and even coming into the first half of June. Freehold active listings have been steady for the last 3 weeks, which is interesting, right? We don't see a massive surge in new listings in the freehold space. The condo active listings are still rising, but it's second lowest rate of increase in the last 19 weeks. So slow down in the number of new listings in the condo space. So if we just stopped where we were at today, things would bounce back pretty quick because we already see the drop has, it seems, unfolded generally. At least that's what I'm seeing. If you guys aren't seeing it, move along. But the X factor, as mentioned, is interest rates, right? Interest rates, we ain't done yet. The story continues. In fact, last Thursday, the Bank of Canada said that some Canadians who took out mortgages in 2020 to 2021, that was kind of the record low for interest rates dropped, could see their monthly payments jump by as much as 45% in 2025 and 2026. 45%, almost a 50% increase. And these are all the people that took advantage of that massive interest rate drop they locked in. Well, 2025 is going to be a costly year. The overall increase in monthly payments for all types of mortgages originating in 2020 to 2021 would be 30%. This is fixed and variable. A 30% increase coming up in the next couple of years. So the deal breaker is this combination of rates rising, but also if Canadians can't afford it, right? Despite prices coming down, affordability is only getting worse as well. So much so, I've actually heard the show Wheel of Fortune is actually modernizing it to reach millennials with some new rules, right? Instead of buying a vowel, they have to rent it. No vowel for you. Okay. So we're going to move on to interest rates, right? So this combination, the question is, okay, interest rates are going to go up. We're going to talk about where we see that too. But can we afford it? Can we afford that increase? CBC.ca tells us no. Nearly 1 in 4 homeowners say they'd have to sell home if interest rates rise more, according to the survey. This came from a new debt survey from Manulife Bank of Canada. The survey conducted between April 14th to April 20 also found that 18% of homeowners polled are already at a stage where they can't afford their homes. Okay. 2025 is going to suck. And they say it's important to remember the survey is an indication of how Canadians feel about their financial situation, rather than a reflection of their actual financial risk, right? But still, what do you guys think? Do you think the way you feel matters? because how way you feel, but your financial situation is the way you feel about listing that property. And that could play itself out in the way of more listings long term if we continue to dive into higher interest rate increases. And the Manulife survey also found that 2/3 of Canadians do not view home ownership as affordable in their local community. I'd like to rent the vowel, please. Maybe interest rate hikes will slow down though, right? Maybe we're almost done? Wrong. Financial Post tells us the stakes just went up in the battle against inflation. Data out Friday not only turned up the heat on the central bank here, but also south of the border. In Canada, the numbers showed the unemployment rate at a new low. It's a good time to find a job, kids, and revealed the tight labor market was putting pressure on wages. With wage growth accelerating, the chance of the Bank of Canada following through with its hint of a larger 75 basis point interest rate hike in July, the 13th to be exact, have risen. CIBC changed its rate forecast Friday, saying solid momentum in the economy and signs that inflation is getting worse, not better, means the bank may have to raise rates higher than their economists expected. Everybody is not expecting this much. They raised their call from a rate peak of 2.5 to 2.75. Faster interest rate increases are game changers. When we're talking about predictions for 2022, nobody expected this much interest rate, right? Nobody, myself included. So, and they want to front load the increases. They're doing them quicker. It's not like we're just going to get there. We got to get there now because of just the state of the economy. So I like to think personally that I'm a bit of a fortune teller, but definitely came short on that one. I love bumping into fellow fortune tellers though. It's a nice chat, right? Hello, your day was fine. How was mine? When we look at bond yields, good indication that rates are going to continue to rise. They've gone up from under 0.5% back in, looks like February 2020-ish, mid 2020. But they've gone all the way up to 3.5% today and rising quickly. That means massive interest rate increases, all of these things. In fact, the 5-year fixed posted rate, I like to look at Scotiabank, they tend to be on the higher side, is 5.29. So another interest rate increase on the 5-year fixed. They're in the low 4s right now, low to mid 4s if you're getting a mortgage. But still, fellow investors, if I were to kind of look at this broadly, I would say on your existing units, the advice has always been make sure you're cash positive, you're cash flowing. And I hope that you guys have strong cash flow. A lot of the calls that I get are for folks who don't. And I'm not going to say that you guys are in the wrong there, but you're going to get caught. And a lot of people are going to get caught. Depending on where you finance, and there's going to be this rollout, right? Rates have been low for a long time. That opportunity to lock in the low rate has been around for 5 years. So people are coming due and they're going to be getting hit with these things. And I hope that as you guys are looking at your portfolios, it's not hitting you that hard or forcing your hand to sell or do something that you wouldn't normally do, but now have to, right? On the other side, on the name of cash is trash, right? But having cash right now is a fantastic thing. And I hope you guys are ready for more real estate deals in various markets. I think there's going to be a lot of opportunities in there for people who are moving up. It is tough, right? Like a lot of people can't afford to move up because they're already strapped for cash. They're stuck as it is. For those of you who can, here comes your opportunity, a good chance to buy, especially when we get a 75 basis point increase in the next few weeks. Well, given that some people are taking a hit, some people are doing well, which real estate companies are taking the biggest beating, right? That slap with the spoon that I used to get when I misbehaved. Can't do that anymore in 2022. Or can you? No. Don't take away my kids. I don't hit my kids. Okay. We start the conversation here with investors. If we're going to talk about who's getting the biggest beating, we got to know one of the biggest trends that we were tracking before all of this transpired was that investors were dominating. In fact, they were the only population of buyers that were growing in the GTA. Well, here we go. John Pasales had a comment. What I've learned from Twitter is that there's a group of voters out there who are very supportive of wealthy investors, individuals or corps, buying up corpse, not like corpse, like dead, corpse, like, corporation, right? And people support them. It's like, oh, it's great. It's piling on the market. It's increasing the value of my asset. I love it. And that's a true thing. I mean, like, great, more buyers, right? Well, to them, the wealthy investors aren't pricing them out of owning their own home. They're creating supply, right? Well, So we've got this balance of investors. According to new data from the Bank of Canada, a major source of incremental housing demand in Canada has come from investors, loosely defined by the Bank of Canada as buyers who already own at least one property, which they haven't done anything in the name of capital gains. And there hasn't been anything to kind of temper this down. In fact, there's been a lot of reasons for people to buy in more, talking namely higher inflation and lower interest rates. Beautiful time to own fixed assets. Well, in 2015, they made up under 18% of buyers. By the end of 2021, listen to this, over 22%. That's a pretty big jump in a matter of like a few years as a percentage of who's buying going towards the investors. Okay, why does this all matter? Because these investors are playing themselves out in the most extreme way in the way that housing is done in the GTA. We've got this article that came out called Private Mortgage Lender Magenta Suspends New Loan Applications Until the Fall. Magenta Capital Corp, one of Canada's largest private mortgage lenders, Key, has suspended new loan applications until September, according to an email to its broker clients, mortgage brokers, viewed by the Globe and Mail. We have this, it's been released, and now we know. But why would they do that? Especially when you have so many people that want to get private mortgages. There's opportunities there, right? And we'll talk about those. Why? The sharp increase in interest rate has made it harder for borrowers to qualify for a loan from a chartered bank, which typically offers the lowest mortgage rate but has stricter borrowing requirements. Additionally, because borrowers qualify for less from a bank, they are increasingly seeking out alternative lenders. This is not a new thing. This has been going on for a while, such as mortgage investment companies or MICs, which pool investors' funds, an opportunity for you to invest your private dollars into loans that are not subject to the same restrictions as chartered banks. You could point this all the way back to from CMHC making it harder and the stress test playing itself through, but then not applying in the private segment. This has been kind of a way of like shadow hiding, I forget the terminology, but hiding from the stress test, right? Well, in an email dated on June 7th, Magenta said it will not be accepting any new applications required before September 1. It did not explicitly give the reason, so we have to speculate. What are some of the reasons they would do that? Reason number one is the lender may be taking a break because the mortgage demand exceeds the amount of capital. Maybe people aren't investing their money into MICs. There's not enough money pooled to fund all the deals that are coming at them, which just speaks to how bad it is in pushing mortgages towards the private space. Maybe, right? Maybe they don't have enough money on hand. It's kind of been chipping away at the funding and they don't have it and can't keep up with demand. But I doubt it because Magenta was established in 1994 and is one of the country's oldest and largest MICs with 430 million in mortgage assets under management, right? Like instead of just canceling your opportunity to lend money, would you not just make it harder or, take advantage of it? The pulling off your name from the mortgage broker list is not a first step. Put it that way, right? It provides loans short-term, they call short-term credit challenges, right? And that oftentimes, as we've seen on our show, includes and is often usually investors, people who are either desperate, which you kind of hope they don't go that way, or like recently we've seen people go there because of necessity in order to close on that property, which we know is going to go up 100,000, but really it's a lot of investors. And that's often you guys that are listening to our show. And it lends throughout Southern Ontario where home prices have nearly doubled in some areas in the past 2 years. There should be a lot of equity in there and opportunities, right? So I just don't see them being in a position where they're desperate and have to do that. So more likely than not, it's reason number two, which is it's getting too crazy out there, right? With the cost of a traditional fixed rate mortgage doubling in the past year, that has made the stress test more difficult. Right now we got fixed rates floating around 4.41, they said, as of last week, according to central bank data, which means the stress test rules must apply that plus 2%, so 6.41%. But borrowers are not subject to the stress test as MICs and other non-bank lenders. This is what kind of been keeping them busy and been pushing people in that way. But then they say, no, stop. We don't want it anymore. When rates go up, less people qualify. So therefore we get more business. This is a Mick from River Rock, Nick Kiprianou, Chief Executive Officer. So I think private lenders are looking at the risks and they're thinking they're too high. They just don't want to get involved with bad investor deals. Investors have been so busy, they've been so active, and they've been a big supporter of MICs and getting some of those short-term projects done and opportunities in there. And they're saying, we're not going to be part of that. The market is too cray-cray. We're out. That was official. That was an official reading from River Rock. Anyways, not official. Some lenders may be taking a temporary break to figure out the market. this is maybe playing into this too. In 2017, ahead of the implementation of the mortgage stress test for uninsured mortgages, she said lenders took some time to assess the landscape. I remember in 2017, I have a lot of mortgage broker friends. Some quit. Some said, this is it. This is bad. Like, this stress test is very difficult. I don't want to be in this business anymore. And some just took time off of work. I remember seeing a lot of people doing this in 2017. It's playing out again here, except this has got to be way, way worse. Like, this is way, way worse in the way of shifts and changes. This isn't just making it more difficult to qualify. This is a market that is in a true bear market right now and has a lot of lenders and therefore mortgage brokers spooked. I have more mortgage broker friends right now who work at banks that are saying that their phone is not ringing. It is quiet because one big part that I see playing into all of this as well, going beyond the private segment, is like, I don't know about you guys. I love breaking mortgages. I think it's like the funnest thing when I know that it's going to make me money. Why not? People are like, I don't want to break my mortgage. But when interest rates are dropping, not too fast, but when you have to be careful because I consult a mortgage broker. I don't want you guys getting caught with all these additional fees. But if you have the right product and the rates go down, you have an opportunity to lock in at a better rate. Why would you not take that advantage, right? If you're in a variable rate and you got a fix, you could jump over to a fix really quickly and lock those in. Well, so you'd have a lot of people with renewals. They jump company to company. Well, not so much now because in this situation now, people are like, they don't want to renew. They don't want to refinance. They don't want to try and you got a home cash. And so I'm going to try and get a mortgage with the rates this low. Those calls aren't happening anymore. And so they're just not as busy. And I could see this playing itself through with the mortgage brokers. So I really do feel bad. I guess that's, the circle of life where real estate sales are down. But I feel like given that I'm in the investment community, for some reason, this year has just been extremely successful. I've already topped my numbers from last year, this year. And I think a big part of that is because we have a lot of listeners like you who are extremely savvy about the market and they're getting ahead of it and they're taking opportunities and they're getting the discounts that they're being offered in this crazy market right now. But when one person benefits, the other loses. So there's no win-wins here, right? It's like my wife's obsession with 69ing. It's costing me a small fortune. I really wish you wouldn't touch the thermostat. It's bloody freezing in here and I can't afford this cost of energy anymore. Jeez. Share this with friends. That's the cost of doing business and listening to our show. And thank you for hanging out with us. And if you don't want to share this with your friends, because that's kind of weird, why would I send it to my friends? I don't have any friends. Share this on your Instagram story. You can tag us at Watson Estates. I would love and appreciate that. And I will see you guys next time. Take care and keep it real.